I'm Paul Carroll. I'm the editor-in-chief of Insurance Thought Leadership. I'm speaking now with Roberta Anderson of the law firm of K&L Gates. We're talking about cyber insurance and risk, which seem to be a very hot topic at the moment. So I'll just start out, Roberta, by asking you, I guess first, why now? Why is this so hot at the moment?
Well, I think that the fact that Target is in the news and data breaches are in the news every single day, so it's gaining increased C-suite attention, greater attention at the highest levels of companies.
Okay. So what should companies be doing and what should insurers be doing?
Well, companies are starting to ask the right questions. I get asked by my clients very frequently now, what does our coverage for data breach look like? Are we covered under our commercial general liability, that's CGL coverage? And theoretically, they should be, and I tell them that, and I'll explain why theoretically in a minute. There should be coverage under what's called Coverage B of the CGL policy. That covers, among other things, oral or written publication in any manner of information that violates a right of privacy. And courts have upheld coverage in numerous instances for various privacy-related claims, including data breach under Coverage B. But the trouble is two things. Last April 2013, as part of its overall revisions to the CGL policy, and this has flown under the radar, ISO introduced an amendatory exclusionary endorsement. And what it does, it doesn't look like much, it's just a few lines, but it takes away in the first instance that entire definition that I read to you that provides the entire scope of the data breach coverage under Coverage B, that's oral or written publication. So if that endorsement has been appropriately approved by regulators and is legitimately in your policy, it's lights out for data breach coverage under Coverage B. Even more recently, to become effective actually in just a few days, in May, ISO has launched a series of data breach exclusionary endorsements, and they purport to very broadly exclude liability arising out of the publication of personally identifiable information, PII, protected health information, PHI, confidential corporate data, and they also extend to forensics, crisis management, public relations efforts, call monitoring centers, basically all of the crisis management activities that you need to undertake in the wake of any significant data breach.
Okay.
So that's a really big deal. Now, it may take a while for these exclusions to make their way into the policies. They're not mandatory, and they're subject to judicial review. And other exclusions, such as the absolute pollution exclusion, weren't so absolute as the insurance industry would have hoped in the first instance.
Okay.
The problem is, and what I tell people is that when you have to fight for your coverage in court, it dramatically undermines the value of that coverage.
Sure.
And even where the exclusions that I've mentioned, the new ones, are not in the policy, taking a step back, the Sony PlayStation litigation.
Right.
That's estimated to cost Sony a lot. Sony's commercial general liability policies have none of the exclusions that I just mentioned. And yet a New York court some weeks ago, just a few weeks ago, held that Sony doesn't have coverage under its CGL policies because it itself didn't do anything. But again, it underscores that you're going to be facing a fight if you're trying to get cyber data breach coverage under your CGL policies. So that's where we are. And that's where I think it's really important for companies to be considering specialty cyber insurance products. Some are very, very good. They're rather like snowflakes. They're all different. They're not manuscripted. Some off the shelf are quite good. Some are quite awful and don't match the reality of e-commerce and its risks. But if you know what to ask for, you can place an excellent policy. And the premiums are very good right now, even for retailers.
So it sounds like the first thing companies need to do is just sort of understand what the landscape is, because they may have coverage, they may not. They may have coverage, but it may require litigation to enforce it.
Absolutely.
So figure out where you are and understand that it's a rapidly changing situation.
That's exactly right.
Month by month.
Adopt a team approach. This isn't just for even the most capable risk manager. It's really a collaborative effort. You want IT involved, in-house and external legal, compliance, and a good broker and risk management, and then define what your risk profile is. Look at what your exposures are and how much they are, where they're coming from. Then you're well positioned to look at your traditional policies like CGL policies to see what, if any, coverage there may be, what's the realistic chance of getting paid under them, and then go from there to negotiate a cyber product that well fits the company's risk profile as you've identified it.
And from the insurer standpoint, it sounds like they're doing a lot of the right things and exploring this and then trying to figure out how they ought to adjust their policies to make sure that the risk fits the premiums they're
I agree
collecting.
with that. Certainly the better carriers in this space. Certainly the 5 that I recommend to companies and organizations when they come to me at the outset and say, we're exploring cyber liability coverage. What do you think?
Okay.
Certainly some of the insurers are doing a very good job of marketing and selling products that provide really good coverage against different cyber-related risks, including data breach.
Okay. Given how much things are changing, is it even possible to look out 3 years, 5 years and say, this is sort of what the landscape is going to look like then?
I think it is. Right now, at my last count, there were 31 insurers, for example, all scrambling hand over fist to get market share in this space. Many of them are selling products that don't match e-commerce related liability and its risks. And I think that in the next 5 years, we're going to see many fewer insurers. I think that we'll be down to about 10, if I had to hazard a guess. And it'll be the better ones right now, perhaps some new ones entering the space. So I think there's that. I think insurers are getting a better grasp on the aggregation risk. That means many of their insureds have data that resides in the cloud. Being stored, handled, managed by cloud vendors.
Right.
And that does spook some insurers a little bit because, of course, if you have a cloud security issue, now you're looking at many insureds that may be negatively impacted. But they're getting a grasp on that risk as well.
Okay, great. Thanks, Roberta.
Thank you.